how, oh, got it. How all the pieces fit together. But what's more important on this slide is that we realize that it's not just how connected these pieces would be, but just how disconnected all these, parties to the divorce are. So, and it's in that disconnect that usually causes harm to the divorcing couple from a legal, financial, and almost always an emotional perspective. So I can give you a better look at what that kind of looks like. And it's kind of like this. Makes your head spin, I'm sure, because there's so many different ways. And this is just a fraction of how many intersections there can be of all the possible overlaps. So you can see the home is in the middle. It's not always, just who is going to, as simple as who's going to be, the one retaining the house and who's going to be simply selling it. There's a lot more involved in the overall picture. And these areas of overlap affect not only the divorcing couple, but it can also impact how each member of the professional divorce team effectively does their job as well, whether it's the attorney, financial planner, mediator, etc. So for all of us involved to provide a higher level of service to the divorcing clients, it's imperative that we really acknowledge how the home can impact multiple facets of the divorce itself, but also life after the divorce. So I always ask the question, so what really makes a successful divorce? And it's the intersection between the divorce and family law, financial and tax planning, real property, and mortgage planning. Mortgage planning is real. We can't ignore it in there. So when we can fit all these four pieces of the puzzle together, and have, effective communications and strategic negotiations in such a manner, like I said, that the divorcing parties come out of mediation whole, or at least on the road to recovery. Again, I said that. I don't know if anyone here has ever heard of a Cdlp, Certified Divorce Lending Professional. Anyone familiar with that? If not, it's probably your first time. So one of the most common questions I get is, how is a Cdlp different than a traditional mortgage professional that you might send to? And the answer is kind of simple. It's the same as you, actually. So if you're a CDFA, how are you different than a traditional financier advisor? If you're a family law attorney, how are you different than a criminal or bankruptcy attorney? If you're a mediator, why did divorcing couples come to you? And basically it's your background and knowledge of divorce. So CDLPs, Certified Divorce Lending Professionals, are simply just, divorce professionals that happen to offer mortgage financing. So we work directly with you and the divorcing family to really examine the opportunities and the home equity solutions that are available to them. And I always say in this, there's so many gray areas. You can't think traditionally when working with divorce and mortgage financing. It's just not possible. So through the strong background knowledge and intensive training that I went through as a CDLP, and that CDLPs go through because it's a specific designation, we're truly a value add to your divorce team and helping the divorcing homeowners make more informed decisions, in their situation. So here's just a few questions that you can look at and think about. And just, kind of take a look at them, and everyone might have a different answer on how it's going to play a different role, in theirs, and how it's a different effect that it'll have on mortgage financing. So what you see, you may be looking and applying this to the marital balance sheet and the distribution of assets and income. But I want to point out through this is that how you addressed, these questions in your divorce cases may actually have significant consequences when mortgage planning is needed, and your solutions or suggestions may not actually make it harder for the divorcing spouses. So I guarantee that a CDLP will look at these questions much differently than you as the attorney, financial advisor, or mediator, because that's what we're trained on. And if I'm going too fast, I apologize. Number one, I'm from the East Coast. Number two, I want to make sure I get all this information in because it's good info, I think. So what is divorce mortgage planning? Divorce mortgage planning is just much broader than divorce lending. Too many mortgage professionals claim to be divorce lenders because they've closed a mortgage loan or two for a borrower. And it's also much broader than someone offers to, collect documents regarding the real property, including the divorce, to help complete a divorce case file. Divorce mortgage planning. Divorce mortgage planning is a holistic approach to evaluating mortgage options and financial objectives in divorcing situations that coincide with the overall divorce settlement. Our job is to help integrate the mortgage into the overall financing goals that help minimize taxes and interest expense while maximizing their cash flow. Our mission is to help divorcing homeowners make more informed decisions regarding their home equity solutions. I know I've said that a million times, but that's what we're here to do. And then most importantly, and I'll be very clear on this, the Cdlp is there to support the legal and financial team. We do not ever give legal or tax advice. That's just not what we're there to do. So that's in, the other professionals' place. So in divorce mortgage planning, there's basically 4 phases of it: vetting the house, qualifying the income, analyzing the consumer debt, and then home equity solutions, that buzzword again. The vetting process of the home and other real property goes beyond determining whether it's marital or non-marital, whether the property's ownership, tax status, and equity and value and equity available. We have to examine the details of the property, because not only are elements vital to you and your solutions of the suggestions, but the details of the real property may determine what type of mortgage financing is available or not available to the client. And this has nothing to do even with credit scores or income. So we analyze the various income sources, including employment income, support income, no income, and what we can do to create some qualifying income. How is the marital debt and individual debt being evaluated in the, during the divorce? And how can we help? Once again, you can read how we can help them make informed home equity solutions, because it all comes together in that. And once again, I've said it before, say it again, just like home equity solutions, you can't think traditionally when working with, divorcing clients and, real property and mortgage financing. So the Cdlp really brings, and everyone brings a different perspective to the table. When working together, we can all provide a better solution to the divorcing homeowners that we're working on helping. So one of the main things this course is income. The biggest takeaway here is that not all income is considered qualifying income. It's not treated the same. So this is one of the biggest hurdles that we face with our divorcing clients. So I thought it would be useful to kind of, give a little clarity on how we would look at it as a divorce professional doing some planning. When working with divorcing clients on mortgage financing, we have certain requirements that have to be met before we can use that income source for qualifying. These requirements must meet stability and consistency tests. And that's also one of the hardest guidelines for a client to understand. And it can create a lot of frustration with them knowing they have sufficient income that's coming in or cash flow every month, but then we end up digging in, finding out what it's about, et cetera, and chunking it down and determine what income source we can or cannot use. We could be dealing with employment gaps. If the borrowing spouse has been a stay-at-home or as the primary giver, or even a recent return to work, as divorce has its own set of issues. So any type of income has to meet its own tests for use, even down to its name. Believe it or not, alimony, maintenance, and spousal support are all treated differently in the mortgage world, depending upon the type of loan type that the divorcing client is going to be obtaining. So when working with myself or another Cdlp, we can work with you in identifying how to categorize the support income to make sure that they're tied together so that we can use the income in various ways during, the divorce financing. We've seen a lot of cases in, the last several years where there's a lump sum payment instead of monthly support. And that's great. You had a big fat bank account for them, but they have no income to qualify. And I actually had that happen. I had a woman who had she was given my card. She held on to it for probably, I want to say 4 months or so. And by the time she finally called me, she had been a stay-at-home caregiver for her kids and everything. And she was getting $10,000 a month spousal support and about $2,500 child support. And she was trying to refinance the marital home of about, I want to say like $800,000 or $900,000. By the time she called me, she had 35 months left, and I need 36 months, which I will get into. So I was like, oh my gosh, I can't help. She's like, Suzanne, I've had your card for 5 months. And I was like, oh my gosh, I wish you had called me. So things really matter with, the documentation timeline. So as I was saying, kind of what I just said, so probably our most challenging income source is support income. It can create a lot of rabbit holes, kind of like what I just did. And the same requirements are in place for support and spousal support and also child support. What I just said, basically you can refer to it and think of it as a 636 rule. We have to prove that they have been receiving that income for a minimum of 6 months. And then we also require that income has to continue for a minimum of 36 months after the loan has closed. So that's the problem when it becomes, if spousal support or whatever is awarded only for 3 years, by the time we can show the 6 months, we don't have the 3 years continuance anymore. So and we can't use it as income. So they're out of luck for that. That's when I was, kind of what I was just talking about with the woman that had the $10,000. So it's a real issue. And I was like, all I had was like $2,500 of child support to qualify her, and that wasn't working, unfortunately. So another hurdle that so for this is meeting that for the documentation and the receipt guidelines. Ooh, I said that part. So the paper trail. So we have to meet that 636, the rule. So let's just say, if the order says spouse A is required to pay $1,000 in spousal support to spouse B by the 5th of every month, and spouse A pays $1,000 in various amounts throughout the month, there's going to be an issue with that support, because we then have, with the stability and consistency, we now have inconsistent payments throughout, because meaning that the court order stated, the $1,000 on the 5th. And let's say, meaning like if the court order is $900 in this case, payable on the 5th of the month, and the paying spouse says, I'll pay you $700 on 1 month, $1,100 on the following month, maybe pays on the 5th, pays on the 20th, the following month, it's not paid as ordered, and it will not qualify as income. So discussing documentation, we need a paper trail. So we either need to show copies of the check deposited, which is obviously easy typically. But a lot of times now people, they're doing, they're transferring the money, they're doing electronic transfers. So it sounds pretty clean, but we have to provide proof that the party transferring the money is indeed the former spouse, which requires that we have to show ownership of that bank account and where the money is coming from. So how many exes have you worked with that are willing to supply a copy of their current bank statement? Tons? Not many? Probably not many. So we don't need a current bank statement. So usually like in the discovery phase, we can use that because we have to show the person's name and the bank account because that'll tie together. So that's the easier way on that. Another thing is to be very aware of is do not net out support payments. As an example, I had spoken with an attorney a while ago. Husband, during temporary orders, was ordered to pay the wife $9,500 in support, and he was to pay the mortgage, the utilities, and the medical expenses directly from that and give her the rest in cash. And she was supposed to refinance within a certain amount of time once the divorce was final, but we couldn't use the income received during the temporary orders because it didn't meet our the requirements that we have for stable and consistent income. So if you're ever in this situation with one of your clients, it's much cleaner to give the whole thing to the receiving spouse and have the receiving spouse pay all those debts from that $9,500. So kind of what I said before, so like temporary orders to meet the 636 rule. So so you have someone that needs to refinance or whatever as soon as possible once the divorce is final. Once we get a temporary order in place and then they start paying, that's going to start the clock. So, and it doesn't matter what the final amount is going to be. If they have, let's say, okay, let's get the clock started with $1,000 a month for child support. And then we see that coming in, and then the final decree comes out, the decision comes out, and it's like, well, they're going to get $2,000 a month child support. Let's say they've made 5 payments of the 1,000. All we need is 1 month of that 2,000 going in. That gives us our 6 months. We do not have to get another 6 month showing that $2,000. So whatever the beginning is, we just care about getting that support, whatever it may be, started so we can start that clock ticking. So then another thing is the infamous lump sum payment in lieu of monthly support. So, maybe you realize this, already, but as divorce mortgage planners, we run into this a lot. So let's say you just had a spouse who just received a $500,000 lump payment and wants to, buy a home or refinance the home as ordered. But if they're not employed, they're not receiving any support, income, child support, or spousal support. They're just getting that. In our eyes, they have zero income. Like I said, they got a fat bank account. Awesome. But in our eyes, we're like, well, you don't have anything. So we have options with loans for like amortizing assets. If they have to have a certain amount, it's a whole calculation we go through, how much we can use, how much they need, depending upon their debts, etc. But there might be, and we do an asset depletion, but maybe there's whether or not there's a penalty for accessing the funds or what have you. So there's a couple of ways that we can create. We would work with the financial person, the CDFA or whoever the financial person is, but a couple of options that could meet the minimum requirements and the continuance to qualify is that they can put that into, let's say, an alimony or a revocable living trust. And it stipulates the amount that they need to qualify. And then you make sure that there's enough in there to have that 6 month, the 3 years after that 6 months that's in there. So you always want to, have the cushion, or maybe there's, a 72T distribution could be an option. Obviously, every situation is different, and there could be certain strategies that could create taxable income for a limited time. However, sometimes we just need to work together for a solution for things. And it's going to depend on the urgency and the needs of each client, all individual. So, but this is a hard thing to overcome if it's not addressed at the beginning stages of the, divorce process, because we need to take into account what the client needs before we let them accept that settlement statement and, signing in ink, because once it's signed in ink, we have to deal with the cards that are dealt to us. I had a gentleman I was working with for a year in Oregon. And by the time I got the decree down, they had that he was paying, he was doing this and paying off additional debts. Can't do that. And I'm going to get into that in a minute here. So those are some of the different options that, there are for trust income. And of course, when you have income, there you have debt. Lovely. So when one party is ordered to make the payment on a specific debt, it's considered a court-ordered assignment of debt, and also known as a contingent liability. In order for this debt, such as a mortgage on the marital home, the current payment not be included in the vacating spouse's new mortgage. Specific verbiage is needed in the settlement agreement. One of the biggest arguments we hear from the departing spouse is that, well, he or she can't afford to refinance the house right now. It's going to be a while, but I'm trying to buy a new house. So what am I going to do? Well, if that wording is not in there, that so-and-so is supposed to pay the house, we have to count it against the others. But if it's stated on who is paying that, we don't have to include it in that other person's, debt to income ratio, as we call it. So understanding, how that assignment debt can help each of the spouses. Same thing goes for sharing of debts. If it's going to be shared between the spouses until it's paid off, it needs to be specific in the settlement and clarified that, let's say both spouses are making 50% of the monthly payment until the debt is paid in full. If those words aren't in there, 100% of each of those payments is going to be hit on each of the people. So we always say clarity is key. Another thing, student loans. I had a divorcing client a while back, and she had a very tight debt to income ratio. I know how far I can push my, the system, but she argued that her husband was required to pay him per the settlement agreement, and he was to make all future student loan payments on their student loans. Well, the issue came when, and the husband was like, I agree, but she had co-signed for a student loan for her son. And even though the husband was like, yes, I'm paying all the future ones, that was not a future student loan. It was one that had already been out. So she had to qualify with that. So if it were addressed that he takes over all future and current student loans, then it would not have been a problem. So like we said, clarity is key. And sometimes, like I said, we just need to strategically work together, on the assignment of debts that you'll put in the spouses in a stronger position for mortgage financing. So like I said, I can't stress enough clarity. It's just come up too many times. This is my favorite part to talk about. So talking about the house itself. When one person is retaining the home and acquiring the interest of the other spouse by paying them off through, their share of the equity, the term is an equity buyout. So it confuses a lot of people into thinking that it's a purchase of a home. It is not. Even if the spouse is not on the current mortgage, it can still be done as a refinance. So just because the court orders one party to refinance the current mortgage, it can't dictate what type of refinance they're going to get in it. That's kind of what happened with my my Oregon guy. He was to pay off his spouse a certain amount of equity. And I had been working with him for a year. By the time I got the decree, it said to pay, the equalization payment of X to the spouse and paying off these debts. Well, you can't do that because the person refinancing the house to buy out the equity to the others cannot get 1 penny back. You can't pay off debt or anything. All they can do is pay off the home and pay the equity to the other person. So luckily he had enough equity in his home. I turned it into a cash out refinance. So that's kind of the thing is, what's the big deal? Rate term refinance, crash out refinance. When I can treat it like the equity buyout, like a rate term refinance, they get much better terms. Their interest rate is better, and they can go up to 95% of the home's value. If you're familiar from your own mortgages, if you've ever done a cash out, you're stuck at 80% of the value of your home, and the rates are higher. So when I can calculate it, when I can treat it as a refinance, rate term refinance, it's much better. So what if the spouse has, 30% equity in the home, and the vacating spouse is awarded 15%, but then something's happening and now they can only access 10% of that. We still have 5% that's due to the vacating spouse if we're stuck with an 80%. So, and another thing is, when you designate a specific dollar amount, it can be harmful if, and kill the loan if the value comes in much lower. And I'll talk about for the appraisals that are ordered. So knowing how to structure it, like I said, the clarity is key, and the verbiage in the settlement can kill a mortgage. I've had it happen. So also we need to make certain things to happen to have them obtain this, good financing option. So the terms and equity of the equity buyout must be addressed independently in the settlement agreement. It can't be equalized with other asset distribution, no debt consolidation, nothing other than the equity share. Independently means just that. Address it completely separate from anything else. Zero cash back, nada. Not even 1 penny can go back to the person. They can't even roll in their attorney's fees. Nothing other than the equity can come out of that. Another thing I run into, the person that's retaining the home and doing the refinance, and we do, like we talked about this in vetting the home earlier, they must be on the title for the previous 12 months. They don't have to be on the mortgage, but they have to have been on title for the last 12 months. If not, that is automatically going to be kicked over and reverted to the cash out refinance situation and stuck with 80% loan to value, higher interest rates. So that's one thing, like I said, during the vetting, I found I had a woman that she said, yep, I'm on it. She wasn't, but when we got the stuff from the title, she had only been on it for 5 months. So luckily, once again, had the equity to be able to do a cash out refinance to get the equity buyout to the departing spouse. Then once again, verbiage is very important. So we just have to make sure that it's all the properties when you're if one spouse is retaining the real property and responsible for paying the current mortgage before the refinance is going through and they're going to be making it, make sure that you address all property expenses, not just PI, not just principal, interest, taxes, insurance. What if, because I've had one that's like, let's just pay, he's to pay the principal and interest, but then there's taxes, there's insurance, there might be an HOA fee, something like that. So all of that has to be taken into account when you're having the other person pay that until, the staying spouse can get it. Realistic time frame. We need to set a realistic time frame, for refinancing the marital home or buying a new one. Some settlement agreements state, 90 days, 120 days. And if support income is required, to qualify again, there might be significant issues if we don't have, those 6 months and the 36 months, and maybe they're going to be forced to sell or something like that. So verbiage in that and having a realistic time frame is important. Kind of what I said here, rarely, I didn't say this before, sorry. This is something a lot of people, when I've done these talks before, I just talked to an attorney here yesterday, and he's like, he's been doing it for 30 years. He's like, I have never even thought about this. Rarely do we ever see the escrow balance, the escrow account that is, you know, collected for, addressed in the settlement agreement. These can be upwards of $5,000 to $10,000, depending upon the size of the house. What are their property taxes? What is their insurance? And the current lender, when this is refinanced, is only, they're going to send this check to the person on the mortgage, because it's automatically going to go to, you know, that party that's on the mortgage. So, and keep in mind that this escrow account is put in place to pay an existing tax liability, because most of the taxes are paid in arrears. So keep that in mind with that. Like I said, it's a big thing. Yeah, I won't do that. So we can kind of wrap this up. Oh, I think I have time here. And look at a case scenario. So here we have, wife is awarded the marital home and is to refinance the current loans into her name within 120 days of the divorce being final. Husband is to receive his equity share of $111,500 upon the refinance of the current mortgage, based on the current divorce appraisal that was done. Wife is to be given $500,000 of the husband's 401k via Quadro. Joint marital debt of $8,000 is owed to Visa to be paid out of equity in home by wife. Joint marital debt of $30,000 to Amex to be paid until both paid in full. Husband is to pay $1,200 monthly spousal support. Husband is paid child support of $800 monthly until child turns 18. So this is an example of a divorce mortgage planning and real property report that we use, and we provide it to the divorcing homeowner and the divorce team. And it contains specific information that is important to all team players and allows us to understand the impact of each, you know, area on the clients, the settlement and the mortgage opportunities. So first things we see, you know, the details of the property. And I'm sure you're going to recognize things in here that you're going to be looking at, and we're going to look at a few different things, but we're currently looking at the home ownership. We see, you know, the subject property. John and Jane Smith are, you know, they're on title. Here you see them on title for the property ownership. I'm just trying to think. Yep. So here it is. The financing spouse has been on property, has been on title for the last 12 months. Fantastic. Over here, they did an appraisal. So we now see an opinion of value. So the estimated equity is the 223. So we see that. Down here, we see that there's property insurance on the home, but only John Smith is on that insurance. So, you know, what happens during that time frame that, you know, he's the only one on it. She's going to be refinancing until that's done. We might have a lapse in coverage. So we have to make sure either she gets on it or whatever, because we don't want to have her not have coverage on that home just in case something happens in that interim time. Here we see that there's an existing mortgage. John is the only one on the mortgage for both of these loans. Not a problem. As we said, she only has to be the spouse keeping it only has to be on the mortgage, the title for the last 12 months, because she's going to be the successor of interest. And then we pointed out because there is a $9,500 escrow balance on there. So if she's, you know, going to be awarded the home, she's going to be responsible for paying the taxes and is going to have to set up a new escrow account. Also pointing out there's an open and active home equity line of credit on this that he is on. So if this is open and active in that time frame, he has legal access to access that money and charge up more debt on that home until the refinance is, you know, and it's going to be attached to the house that she's going to have to deal with. So here's some scenarios that we would run. In the first scenario, we see that I gave it away. We see that we're structuring it exactly as it is in the settlement agreement. She is paying off the first and second mortgage. We're doing the equity buyout of the $1,150, $111,500. I'm like using my cursor, you can't see, sorry. Third line down for the equity buyout. And we're paying off debt of the $8,000. The problem is, if you look at the loan to value, last line in the top box, we're at 87%. So based on how that settlement was structured, dead deal, can't do it. So let's take a look at the second one. Maybe we'll pay out the 8,000 debt that was ordered. And then we have to stay at the 80% because it's a cash out, but then she can only pay off $60,000 of the $111,500. But then we still got to figure out where's this $51,500 going to come from to get to the full $111,500 equity that he's supposed to get. So that ends up being a problem. So then lastly, in scenario 3, okay, let's do 100% of the equity buyout. We're still over 80%, but that's okay because all we're doing, we're not paying any debt off at the closing. So we're fine to be over the 80% because it's going to be treated like a rate term refinance. So one solution could be, let's award Mrs. Smith, the one keeping the house, the escrow balance that we saw of $9,500 because she's going to have to set it up. So it's going to be sent to Mr. Smith because he's the only one on the mortgage, but in the settlement agreement, he has to sign that over to Mrs. Smith because she's going to be the one obtaining the financing, starting up a new escrow balance. And if it's an existing liability, it should probably be paid by both at this point in time, I would think. Another thing we look at in layout is all the other financing details. What can be used, what's been addressed and what's not been addressed, and we don't want to overlook anything. So right here, we see that she has been receiving spousal support, but she has only been receiving it for 1 month. Poof, can't use it. Doesn't have the 6 months. Child support, she's received 1 month, but we can't use that because it's not going to be continuing for the 3 years because one of the kids is probably 16 or 17. So that's not going to be able to be used. And then down here, we need to clarify, as we talked about before, the percentage of payment. We've got to clarify who's paying what percent of that payment. Otherwise, they're both going to get hit by it, or if it's 50-50, 75-25, whatever. So clarity is key. That statement coming up again. So we have it, set up for both parties on what we can't do. And then we also have, in the end options, she was being awarded the $500,000 from the Quadro, great cash in bank, zero income. So before that $500,000 is distributed to her, work with the team and maybe use some of the payments to create the required income that she's going to need. So let's say, like we said, great, 500,000 cash in bank, no income. So let's say for whatever she has before, she needs an additional $2,500 of monthly income. Got to prove it for 3 years. That's $90,000 that she has to have. However, if you remember, we've got to have the additional, the 6 months that she has to get. So we would say, okay, let's create a revocable living trust, use $100,000 to fund that. So it's prior to distribution. So it's not a self-funded, trust. And then create a distribution for her of $2,500. The benefit with creating a trust like this, we only need to prove 1 month of distribution to use as income to qualify for the mortgage. So that's awesome. And then also it gives enough time because it's going to meet the 120-day deadline that was listed in the decree. So that's one option that, you know, can be done, you know, and like I said, created with a financial person or what have you. So that's that. But I said, we see divorce settlements agreements all the time, and, you know, having the opportunity to work with you and the rest of the divorce team, is, you know, it allows us to all put the clients in a better position. The intersection is real that between all of us, and nothing matters more than putting the right players on the field. All the clever strategies and technologies in the world are nowhere near as effective without great people, you know, on the team to put them to work. To wrap up, another question I get a lot is how much are my clients going to have to pay to, you know, utilize a Cdlp during the settlement process? I'm expensive at $0. It costs absolutely nothing to talk to me. A Cdlp cannot charge a fee for consulting. Why? Because under the Federal Trade Commission, ECOA, marital status is a protected class, and the mortgage industry is heavily regulated. We've got the Consumer Finance Board, RESPA, TILA, everything. And they will see that if I charge someone as discrimination. There's two types. There's like overt evidence of discrimination is when a lender blatantly discriminates on one of the protected classes. And the other one is a disparate treatment, which is when a lender treats an applicant differently based on one of the prohibited factors. So if I were to charge a divorcing client a consultation fee, but not, let's say, a first-time home buyer, they're going to see that as discriminate and disparate treatment under ECOA, because that's a protected class. So like I said, $0, doesn't cost anything to talk to me. So that's kind of it. Like I said, to make a divorce successful, I mean, we can create predictable collaboration and produce creative synergy together. And that's when 1 + 1 is more than 2. And we love that. So collaboration, it just brings a different perspective and knowledge to the table, which ultimately will offer better solutions and outcomes for that divorcing, you know, couple. So just remember, you know, divorce settlement is a result of putting these pieces together. We saw how disconnected they were before, so that our divorcing client that we're working with is going to come out whole, or at least on the way to, you know, recovery. So I thank you guys so much for your time. I hope you found it interesting and informative. I'd love the opportunity to, you know, help you guys with your cases. Reach out anytime. My information will be sent, and that's
Suzanne, let's close up. I have collected, and we'll